Hey everyone, Bill Lethman here for Money Evolution. In today's video, I'm going to be talking about some common Wall Street wisdom that could actually cost you money. So first of all, these are just my opinions, but I still think there's some things to think about here when it pertains to these three key items. So number one, we're just going to dive right in real quickly, is buy and hold. And so again, I think if you're a long-term investor and you're fine with the ups and downs of the market, just simply buying into a portfolio, holding on to it for the long run, no matter what's going on with the economy, no matter what's going on with the stock market, I think that's fine. But that's what you hear a lot of times. Don't try to time the market. And I'll grant you that it is very difficult, or it is impossible to time the market. We use a system known as relative strength investing there. I don't really want to call it market timing, but we do tend to look at trends and when things are shifting momentum, maybe from stocks to bonds, or maybe when there's a time we should have more international stocks versus US stocks. And there's a very specific way that we do that. But a lot of times, unfortunately, people with the very best intentions of buying and holding a portfolio oftentimes panic at exactly the wrong time. And we know that to be true because we see the inflows and outflows into indexes and to mutual funds, and we see the money coming out when the market is down, and we see the money coming in when the market's at the top of the market. So buying and holding may or may not necessarily be the best approach all the time. What I will say is this is, again, this is just my opinion, but one of the reasons that a lot of Wall Street advice is to keep your money in the market is because as long as the money's in those mutual funds, as long as it's in the market, they're continuing to make fees on that. If you take your money out of the market or out of those mutual funds, then those investment companies are no longer getting fees. Now, whether that's the motive behind it or not, again, that's not anybody's opinion other than my own, but buy and hold may not necessarily work. And something else I've talked about in a lot of other videos is if you look at the historical trends of the market, there have been many, many times over the last 100 years or so where the stock market has literally gone through stretches of 15, 18, as long as I think 25 years where the market essentially has had no growth and has had declines of 40, 50, 60%, I think in some cases almost 70% during the Great Depression. And so, especially if you're coming up on retirement, is that something that you're going to want to hold on to? So anyway, if you're looking for a strategy that can look at some of the relative strength in the market, that's something we can do. There should be some links, to some of our stuff. If you want to look at some of our videos and how we do that, that might be something to think about. So number two is taking Social Security early. And so this is something that we've talked about in a lot of other videos. I'm not going to get into too much detail here about why that's not the right thing. But if you think about it, a lot of clients, they come into us, maybe they're planning on retiring at the end of the year and they're not quite their full retirement age. So a typical conversation might go like this: hey, I'm going to retire at the end of the year. I'm 62 years old and I've got a gap. I've calculated how much money I need for my retirement. I know how much my lifestyle expenses are, and I don't quite have enough money coming in from whatever sources they are. And so turning on Social Security seems to be the easy button there. If I turn Social Security benefits on right away at age 62, I completely solve my gap and life is good. And as a financial advisor, the easy thing would be to just simply agree with that client and say, yeah, that sounds great. That sounds like a great plan. You can meet your goals. You can turn Social Security on at 62. But we've already talked in some of the other videos about what some of the risks are, dangers, I should say, of taking Social Security at an early age. Number one is you're permanently locking in that lower value. If your spouse is also somebody that might be dependent on that value for a survivor benefit, you're also permanently locking in that lower value for the survivor benefit as well. But the other thing you're doing that we've talked about is you're also delaying most of the time the withdrawals from your retirement accounts. And so those retirement account assets continue to build up. And eventually, though, we know that there's going to be a time when you're going to be forced to take those monies out, and it's your required minimum distributions or your mandatory withdrawals that you need to take after age 70 and a half. In fact, they actually might change that number to 72, but that's another topic we'll get into later. But anyway, for right now, as of December of 2019, it's age 70 and a half. But that sometimes can mean more taxes later. And so if you think about that, from a financial advisor's standpoint, not only is it just simply easier to agree with the client and say, yeah, take your Social Security benefits at 62, but I also get to enjoy the increased benefit of having that money invested and the fees that portfolio will generate. If I tell the client to delay taking Social Security to age 67, then they're going to be required to start taking some money out. Not going to be required to, but they're going to probably need to take some money out of those retirement accounts and pay taxes on it and everything. It's less money that we manage, even though it's probably the right thing to do for most people. We've talked about it that full retirement age, which is probably age 67 for most of you watching the video. That's probably the age that most of you should take your Social Security benefits. But again, a lot of times some of that information may go missed. And again, these are just my opinions here. We do this in a very sophisticated fashion through our comprehensive financial planning tool where we're mapping out cash flows. We're also going into detail on what the future tax rates are so we can compare one decision of taking Social Security early versus delaying and what the impact is not only on the Social Security benefit but also on those cash flows and some of those future tax rates as well. So again, some of the common wisdom might be to just take it at 62. I want you to at least rethink that, do your own calculations and make that decision for yourself. Okay, number 3 is the Roth. And if you've watched any of my videos, you probably know already just how big of a fan we are on the Roth IRA, the Roth 401k, the Roth conversion. We talk about it a lot. And again, this is my opinion of things, but I don't think we hear enough about the Roth options in general. You know, we don't hear it if we're participating in a 401k plan at work. Most of the time, the common wisdom is to take the tax deduction right now. Why would I want to add that to my tax bracket today when I can delay that into the future? And this idea that we're going to be in a lower tax bracket in retirement than we are when we're working, I think that's a huge myth that just simply is not true for a lot of people, especially the people that we're doing this long-term cash flow planning on, where we can see what that future tax rate might be based on some of the projections and the hypothetical rates of return and inflation and things like that within there. So the Roth, okay, and so that could be, you know, where you contribute. You know, are you contributing to the Roth? Or are you contributing to the traditional? And again, if you think about it, if you've got $1 million in a 401k that you haven't paid taxes on, or maybe it's in an IRA account right now, and you think about it, and you got $1 million there, need another zero, what is that account really worth? You know, and obviously, if you liquidated the whole thing, you're going to be in a very high tax bracket, and you'll probably be lucky to get barely half of that money back out. But even if you're distributing that over a period of time, is it worth $800,000? Is it worth $700,000? If you're in a really high tax bracket, maybe it's only worth $600,000. And your IRA account could be more than $1 million, probably is. It's maybe $2 million or $3 million or $4 million, or at least maybe it will be. And so again, it kind of goes back to that, what are the fees that you're paying? Whether you're doing it yourself and you're even doing it in a low cost fashion, or you're working with a financial advisor. Again, maybe one of the reasons that we don't hear more talk about the Roth is because, you know, these financial firms are actually managing bigger portfolios because it includes not only your money, but the money that you're eventually going to have to pay the IRS in the form of taxes later. You know, so if I said, hey, put the money into a Roth instead, or somebody recommended that, and you have $700,000 built up, and they're charging a 1% fee or whatever it is off of that, versus $1 million that's built up. Again, these numbers might be exactly equivalent to each other when we're thinking about the after-tax numbers. But think about that and make sure that you're making that decision based off of what's going to be best for you and your situation. And again, we don't hear this a lot, but the Roth is something that I think a lot of people might be completely missing the boat on. So anyway, there you have it. Those are 3 of these Wall Street kind of pieces of advice that, you know, may be steering you in a slightly not so great destination there. Think about it for yourself. If you want to learn more about some of the financial planning that we do, we have a comprehensive financial planning tool that we do. You can check out a link, I think, right below this video where you can get more information about that. Schedule, if you want, a free introductory call with me and see if it's something that might be right for you. So anyway, with that, have a great day. Hit subscribe, and I'll see you back here in my next video. Thanks.